Good morning, one and all. A super volatile week ended amid bets on Fed's rate hike stance. Everything from dollar index to gold and oil to industrial metal witnessed wild swings, with questions still remaining on whether Fed will take a pause on its rate hike stance in its June meeting. Let's understand what lies ahead in the fresh week in this weekly commodity audiocast with me, your host and guide Ravindra Rao from Kotak Securities Commodity Research Desk. The widely expected yet highly anticipated decision came from FOMC May meeting, but this failed to calm investors' nerves as banking sector woes resurfaced. During the May FOMC meeting, the Fed raised Fed funds rate by 25 basis points to a range of 5% to 5.25%, marking the 10th straight increase, bringing borrowing costs to their highest level since September 2007. Fed Chair Jerome Powell hinted the US central bank's latest interest rate increase could be the last one, but stopped short of declaring victory on its battle against rapid price increases. Despite the recent failure of First Republic Bank, Powell acknowledged that the banking conditions have broadly improved since March. Powell also said that Fed can't protect the US economy from the debt ceiling default. These boosted bets of a rate hike pause, but Fed chair was quick to dismiss hopes of a rate cut anytime soon. US dollar index that opened the week on a positive note once again fell close to the support zones near 100.80 as renewed concerns on the strength of US regional banking stocks, coupled with Fed pivot, prompted sell-off in greenback and the US Treasury yields. On the technical front, US dollar index is still holding the support of 100.80 and the resistance is pegged near 102.97, which is the 52-day moving average resistance. So until this said levels hold, we expect the consolidation to continue. A break of 100.80 on the lower side might further pull it lower and it might fall towards 99.38. So until then, we expect the consolidation to continue in US dollar index. Coming to commodity specific, COMEX gold came close to a record high of $2089 per troy ounce before pairing gains and closed the week at $2024.87 per troy ounce, up by 1.29%. MCX gold jumped to a record high of rupees 61,845 per 10 grams on the MCX. The initial rally was amid a renewed turmoil in the US financial sector and dovish bets for the Federal Reserve. Jitters regarding deepening route in US regional lenders and US debt ceiling standoff added further spark in gold. Silver too gained momentum and hit a 1 year high of $26.43 per ounce per troy ounce, completely ignoring the decline in industrial metals. However, the rally fizzled on Friday as a US NFP, that is the non-farm payrolls data increased by data showed an increase of 253,000 jobs for the month of April, beating estimates of 180,000, while unemployment rate was 3.4%, lowest since 1969 and lower than expected 3.6%. Average hourly earnings, a key inflation barometer, rose 0.5% month on month, more than 0.3% estimate, pushing year on year figure higher to 4.4%. Although NFP data was strong, it has not significantly added to rate hike bets in June, thereby keeping dollar under pressure. This indicates we are probably at the peak of Fed funds rate and might see a pause during the June FOMC meeting, which might be a major trigger for bullions going ahead. On the price action front, COMEX gold needs to take out the identical triple top resistance near 2089 $2090 per troy ounce. If that happens, the bulls might target $2150 per troy ounce. However, if the bulls fail in taking out the resistance, corrective dips are possible, which might once again attract buying. In case of silver, COMEX silver has been consistently trading above the $25 mark. And it tested $26 twice. Now 26.10 or $26.20 would act as a resistance. Above that, we might see silver prices going higher towards $27. Volatility might be there, but dips might attract buying in both the precious metals. Coming to energies, WTI crude oil witnessed sharp sell-off as it spiked to as low as $63.60 per barrel, more than 17% from last week's close amid persistent concerns that higher interest rates could slow the global economy and hurt energy demand. Declining refinery margin in Asia and falling US gasoline demand extended the losses in oil. However, the prices later recovered to end the week down by around 7%, recovering almost 10% from the lows, registering its third consecutive weekly loss. A surprise contraction in Chinese manufacturing activity amid weakening global demand also clouded the outlook for the world's top crude importer. On the supply side, Russian crude oil shipments jumped above 4 million barrels per day, despite country's pledge to reduce production. On the technical front, crude has once again, the WTI crude has once again taken support near the 200 week moving average support of 66.90, even though it went below that, but it was a spike and it closed well above the support. On the daily charts, there is a interesting formation of a morning star, which is a bullish indication. But for confirmation, the price has to close above $72, and if that happens, we can conclude that a short-term bottom is in place near $64, and the prices might once again move higher to retest the immediate resistance of $76 per barrel, which is the 52-day moving average resistance. In case of natural gas, prices have been trading lower, but there is a positive divergence between price and momentum oscillator RSI. Plus, there is a piercing candlestick formation, which is indicating a positive movement, a possible positive movement this week. However, the piercing candlestick pattern should confirm, and the confirmation will come only on a close above $2.20 per MMBTU, and if that happens, the prices might once again move higher to retest $2.330 on the higher side. Finally, coming to base metals, industrial metals also extended the drop as fears of a US recession and more signs of a patchy recovery in China weighed on risky assets. Both the Federal Reserve and the ECB, that is the European Central Bank, raised their policy rates by 25 basis points in the previous week, fueling fears that tightening financial conditions will push major economies into a recession. On the price front, MCX copper has registered a bullish bearish engulfing in on the weekly charts, and it has been confirmed. So there is a possibility it might trade with a lower bias. Immediate resistance is near 760, and a strong resistance remains near 780. So any rise might see some kind of a selling pressure coming in because of the recessionary fears. And on the lower side, support is near 725, which the bears might try to target. In case of zinc, prices are trading close to 200-day moving average support on weekly charts, which is close to 236. So until it doesn't close below 236 on a weekly basis, prices might try to give a retracement rally towards 248. So to conclude, although the US NFP print was strong, investor confidence remains fragile as regional lenders do have a lot of deposits unprotected by the Federal Deposit Insurance Corporation. Besides, unprecedented fears of debt default linger if Congress does not raise or suspend the borrowing limit in the next few weeks. Further, worries that ongoing banking turmoil may lead to tighter credit conditions reinforce bets of a deeper recession. Having said that, it has also pushed odds of a rate cut higher, with CME Fed funds futures implying a 47% probability of a 25 basis cut as soon as July. Besides, market will focus on US CPI and UK monetary policy meeting in the week. US CPI is likely to stay at 5%, slowest pace in nearly 2 years, but it is still well above the Fed's 2% target, while Bank of England is widely expected to announce a 25 basis point rate hike, and more hikes may be likely since inflation is still about 10%. Well, that's all from this edition of Commodity Weekly Audiocast. Markets may continue to be volatile, so trade safe and good luck.